Good morning, friends. Let's start with a new area today. So I'll move to chapter 7, which is on pricing decision. Just a minute. Okay, it's going to be combination of case studies and problem solving as far as this chapter is concerned. Let me first explain the initial part of the theory which is there in this area, and then we move ahead and start solving questions. Now, as far as pricing decision is concerned, we start with something called as a theory of price. Now, an optimum price is one which leads to maximum profits for the company and not maximum sales. I can keep increasing my sales by reducing the price of a product, but beyond a point, if you start reducing, your overall profits will not increase, whereas it will reduce. So what the theory of price says is that an optimum price is one for a company which leads to maximum profits for the company, and the focus is not on maximum sales. Your focus is always on maximizing the profitability of the product, overall profits of the product, rather than maximizing the sales of the product. So this is the important thing. Optimum price is the one which yields the maximum profits for the company and not the maximum sales. Our focus is not on sales, our focus is always on profits. Now in this there is one theory which is called as profit maximization model. I'll explain this with an example. Just a minute. I'll explain the profit maximization model. Okay, now as far as profit maximization model is concerned, let's assume there is a product there's always a relationship between the selling price and units sold. As you change the selling price, your units sold can increase or decrease depending on what are you doing with. Let's assume the selling price is 10, I'll sell 5,000 units. Now the question says any change in selling price by 1, the change in units will be 2,500. So if you fix the price as 10, you will sell 5,000 units. But if you increase it to 11, you will sell only 2,500. If you increase it to 12, you will sell 0 units, because the number of units will change by 2,500 if you change the price by 1. If you make it as 9, 7,500, 8, 10,000, 7, 12,500, 6, 15,000. So that is the kind of a relationship which will be given in the question. That is, if you change the selling price by some number, your units will also keep changing. Your units will also keep changing. The rate of change in units and the rate of change in price is expected to remain constant as far as this profit maximization model is concerned. Now in this scenario, they'll say what is the optimum price to be sold. Now I have given 8, 9, 10, 11, 12. In between there can be a 10.5 also. There can be a 10.2 also. There can be a 10.9 also. At 10.9, what units you will sell, the relationship will tell you. If you change the price by 1 rupee, 2,500 change. If you change by 90 paise, 2,250 units change. If you change by 80 paise, it is going to be 2,000 units change. So I don't know what price to work out, because if you give me 5 alternatives and find the maximum profit, I can do it. But if the problem talks like this, there are not 5 alternatives, there are 500 alternatives. You don't have an end to the available alternatives which are there. So that is where a profit maximization model came in, which said that an optimum price is one where the marginal revenue is equal to marginal cost. Wherever the marginal revenue is equal to marginal cost, that's the optimum price for the company. Any price below that, the marginal revenue will not be sufficient to earn the marginal cost. So in that case, you are not going to make extra profits, whereas you are going to make losses. Incrementally, the losses will come in rather than making profits. So the objective is to find a level where my marginal revenue is equal to marginal cost. That's the concept which it says. Now there is a relationship which is established. Price is equal to A minus BQ. Marginal revenue is equal to A minus 2BQ. You will have to find this relationship. Price is equal to A minus BQ. Marginal revenue is equal to A minus 2BQ. First, you will have to find the equation for price, then form the equation for marginal revenue. You will equate MR equal to MC and get what is the optimum price for the company. Now, price equal to A refers to the price at which you will sell 0 units. A refers to the price at which you are going to sell 0 units. What is A in this case? 12. B measures the rate of change between the units and the price. That is the rate of change. That is, if price changes by 1 rupee, units change by how much? 2500. So my B is equal to it can be 2500 by 1 or 1 by 2500. How it is right, I'll explain now why it is 1 by 2500. Now, these are the units. In this equation, if I substitute 10,000, what will I get? Can you substitute 10,000 in this equation? Q is equal to 10,000. 8, then the equation is right. If you substitute 5,000, then whatever equation we have created is right. 12 minus 1 by 2500 Q. If you do 2500 Q, it will not work out. Minus 2500 Q. It has to be 1 by 2500 Q. Any doubts on the equation formation? A refers to the price at which you are going to sell 0 units. B measures the rate of change between price and quantity. I always have a confusion whether it's 1 by 2500 or 2500 by 1. Form the equation, substitute Q and see whether you are getting the right price. Now this is A. This is B. Now I want to substitute this in MR. MR equal to 12 minus 2. 12 minus 2 into 1 by 2500 Q. MR is equal to 12 minus 2 into 1 by 2500 into Q. Now the question will give an information called as marginal cost. Let's take that is 8 rupees. The marginal cost of the product is 8 rupees. That is the cost of producing a product is 8. What we have to do is MR equal to MC. MR equal to MC. 12 by 2Q by 2500 is equal to 8. Can you solve and tell me what is Q here? 12 minus 2Q by 2500 equal to 8. Twelve minus 2Q by 2500 equal to 8. Q is equal to how much? 5,000, no? 12 minus 8 will become 4. 4 into 2500 is 10,000 divided by 2Q. So Q is equal to 5,000. Q is equal to 5,000. Now if I substitute Q of 5,000 in this equation, I'll get the optimum price. What is the price at which the company has to sell the product? That is in this equation. So ideally the optimum price for this company is this, 10 rupees and 5,000 units. This is what price maximization model says. There is an equation for price, there is an equation for MR. We'll have to equate MR with MC and based on MR with MC, you will get a final answer as to what is the optimum price for the company. So this is what would have been covered here. Price equal to A minus BQ, P equal to price, B equal to slope of demand curve, change in price by change in quantity. A refers to price at which the demand is 0. A basically refers to the price at which the demand is 0. Marginal revenue equation is A minus 2BQ. Price is A minus BQ. MR is A minus 2BQ. You will have to remember these two equations. Sometimes the question may give the equation itself, or you may have to form it and then do it. A minus BQ and A minus 2BQ. Marginal cost is equated with marginal revenue to identify the optimum quantity. Based on that optimum price is derived. Let's do one problem on this. Question 11. Question 11. Page 256. Page 256, question 11. Okay. AHL produces product A. To manufacture 1 unit of A, variable cost of 2,20,000 is incurred. Variable cost is basically the marginal cost, per unit incremental cost which you incur. Market research has indicated demand will increase by 2 units for a price change of 5,000. Somewhere the change in price and change in quantity relationship is given. Quantity will change by 2 units, price has to change by 5,000. The company can sell 20 units at a price of 4,60,000. I'll have to first form the equation for price, then form the equation for marginal revenue, equate it with marginal cost, get the quantity to be sold, and then get the optimum price. Next, let's start. Formation of price equation. Formation of price equation. Formation of price equation. Price equal to A minus BQ. Price equal to A minus BQ. Price equal to A minus BQ. Below that, write A refers to the price. A refers to the price at which 0 units would be sold. A refers to the price at which 0 units would be sold. Price at which 0 units would be sold. Okay. Now can you read this and tell me at what price will you be selling 0 units? Read it carefully and let me know. At what price will we sell 0 units? 20 units can be sold at 4,60,000. At what price will you sell 0 units? How much? it will not be 25,500. No, price of 4,60,000 is for 20 units. No, 20 units 460. Yeah, how much? Yeah, it will be 410. It is 20 units 460. 18 units 455. 5,000 reduced. 16 units 450. Yeah, 16 units 450. 14 units, it goes on like this. As you reduce the price by 5,000, you will keep increase 5 lakh 10. As you increase the price by 5,000 rupees, so the equation is like this: 20 4,60,000. This becomes 465. You start selling 18 units. It becomes 470. You sell 16 units. 475. 14 units, go on like this. 0. As you increase the price by 5,000 rupees, you will have to increase price 10 times by 5,000. If you increase the price by 5,000 10 times, units from 20 will drop down to 0. As when the units will fall only when the price increases. Any doubts on this? Any doubts on this? Now full stop. The company sells 20 units. Sells 20 units at a price of 4,60,000. 20 units at a price of 4,60,000. At a price of 4,60,000. Full stop. The units will change. The units will change. Units will change by 5,000. Will change by 5,000 when the price changes by, sorry, the units will change by 2. The units will change by 2. The units will change by 2 when the price changes by, 5,000. When the price changes by 5,000. Full stop. The number of units will come down to 0. Number of units will come down to 0. Will come down to 0 if the price will come down to 0 if the price is increased. If the price is increased, if the price is increased by 5,000 10 times. If the price is increased by 5,000 10 times. Full stop. Hence company will sell 0 units. Company will sell 0 units at a price of 5,10,000. Company will sell 0 units at a price of 5,10,000. Clear? Any doubts on this? We are done with A. Now price is equal to 5,10,000 minus, either it is 2 by 5,000 or 5,000 by 2. Tell me, what should I write? BS. 2 by 5,000 or 5,000 by 2. Whatever you do, see, please listen. What I normally do is I write 2 by 5,000 or 5,000 by 2. Whatever it, write and substitute here. Substitute maybe 18 in the formula and see whether you are getting a price of 4,65,000. Whatever equation you form, substitute 18 in that equation as Q and see what price you get. If you get 465, you have formed the equation correctly. If you don't get it, the equation formation is incorrect. B refers to change in price and change in quantity relationship. There's a relationship between change in price and change in quantity. What is that relationship? What should I write? 2 by 5,000 or 5,000 by 2? Please participate. Either it is 2 by 5,000 or 5,000 by 2. Don't look into the theory and all. Tell me what it is. If you do 2 by 5000 and substitute, you will not get the answer. That is what I said, you substitute. What it will become? It will become 2 into 18 by 5000. The price will remain same 5,10,000 itself, because 2 into 18 by 5000 is less than 0. Sorry, it's less than 1. So the price will continue to remain 5,10,000. So the equation is not this. The equation is, if you substitute now 18 here, 5,000 into 9, 45,000. 5,10,000 minus 45,000, you will get this 4,65,000. That's why I said substitute. Try substituting and see whether you are getting the equation. So price is equal to, write the equation, 5,10,000 minus 5,000 by 2Q. 5,10,000 minus 5,000 divided by 2Q. 5,000 by 2Q. Any doubts on the price equation? Clear? Can I proceed? MR equal to A minus 2BQ. MR equal to A minus 2BQ. What was A? 5,10,000 minus 2 5,10,000 minus 5,000 Q. A minus 2BQ. 5,10,000 minus 5,000 Q. Five lakh 10,000 minus 5,000 Q. Clear? Now next, MR equal to MC, marginal revenue equal to marginal cost. 5,10,000 minus 5,000 Q is equal to, what is the marginal cost? Variable cost. Solve this, you will get the Q as a balancing figure. This is the number of units to be sold. This is the optimum number of units to be sold by the company. Maximum number of units which the company should sell will come out of this equation. How much? 58. Now listen, I'll maybe again explain this. We started with the price ka equation, whereas A refers to the price at which you will sell 0 units. B measures the rate of price and quantity change. There's a relationship between the price and the quantity change which is getting measured in terms of B. We formed this equation. I cross verified this equation with this chart which was there side by side. Then we formed the equation for MR. Now I have to sell 58 units. My optimum price will come from the original equation. Price equal to A minus BQ. You know A, you know B, you know Q. Substitute it and get what price you should fix. We know A, we know B, we know Q. 58 units is what I want to sell. 5,10,000 minus B was 5,000 by 2 into 58. What is the price? 3 lakh. This is the optimum price to be fixed by the company. At this price, they will make the maximum profit. If you fix the price of 3,65,000, you are going to make the maximum profit. Any price below that or above that will not give you the maximum profit. 365 is the right price for this company. Clear? So the moment you are able to develop a linear relationship between price and quantity change, practically the relationship may not be as smooth as like that. That is, you change your price by 5,000, units change by 2 units. That may not happen in a practical world. But the equation says that if you are able to form such a scenario, then you can find the optimum price. Clear? Any doubts in this? This is the price at which I can make maximum profit. If I reduce the price further, my sales will keep moving up, but my profits will not move up. My sales will keep moving up, but my profits will keep reducing. Clear? Can we proceed? Any doubts on this? This was the first concept here. So theory of price, we have started with profit maximization model, which was price is equal to A minus BQ, MR is equal to A minus 2BQ, MR equal to MC, get the price, get the quantity, based on the quantity, get the price and go ahead. Clear? Any doubts on this? Next comes pricing under different market structures. Before pricing, you have to know the different market structures, whatever you have learnt in economics. What is perfect competition? There are large number of buyers and sellers. You are going to basically sell a homogeneous product. There is no differentiation between the product. It is a homogeneous product. An example is rice. Now my rice is available at multiple shops. I cannot differentiate between rice of one shop vis-a-vis the rice in the other shop. Or petrol. Petrol is a homogeneous product which is available in so many petrol bunks. You cannot distinguish between one petrol vis-a-vis the other petrol. So all these are perfectly competitive market. Monopoly, only one supplier. Monopolistic competition, it's more or less similar to your perfect competition, just that you are selling similar products, not the homogeneous product. An example could be FMCG product. Soap is being manufactured by so many companies. Now soap which is manufactured by different companies falls under monopolistic competition. It is a similar product being produced by multiple. You may stick on to one brand if you are interested, if you are happy with that brand, but all the people are giving you a similar product. You cannot be majorly distinguishing one product vis-a-vis the other product, providing they cater to the same product scenario. So if they are catering to the same product or the same set of customers or same market, it falls under a monopolistic competition scenario. Oligopoly, there will be few sellers. Instead of, an example of oligopoly is oil and marketing companies. In case of India, you have BPCL, you have HPCL, you have IOCL. So few set of players are there. So they will fall into the scenario of your oligopolistic market. Now this understanding is not majorly critical from a problem solving, but maybe becomes critical if at all you are doing a case study kind of a scenario. These and all is not that critical. I'll get into the critical part. Okay, these are the pricing methods. This is what a company will fix a price based on. If Bharadwaj Institute is trying to fix the price for the courses, it can be based on competition, it can be based on cost, it can be based on value. Now based on competition, there are two scenarios: going rate pricing and sealed bid pricing. What is going rate pricing is, there is a product, okay, let's take the product as CA classes itself. If that's a service which is being provided, 50 academies are there in India which provides this service. Somebody notes down the fees of all the 50 academies, takes an average of that. That's called as going rate. Average of the price being charged in the industry is called as the going rate in the industry. What going rate pricing says is, you should fix your price closer to the going rate. Do not fix a very high price, do not fix a very low price. not perfectly apt for something like CA classes, because there is a lot of customization which comes in here, because in CA classes there is a lot of customization which comes in, a lot of value differential which can be there. A product can be rice which is being sold at multiple shop. Now there can be even different brands of rice which exist, but practically speaking I may not be in a position to distinguish one brand of rice vis-a-vis the other brand of rice majorly. If the variety is same, one brand of rice or one brand of wheat is going to be more or less similar to the other brand of wheat which exists. Now if there are 50 players in the industry, an average of that is called as going rate, and you should fix your price closer to the going. Any idea what is sealed bid? Any idea anything which comes to your mind when I say sealed bid pricing? Okay, what is sealed bid? If at all, what is your understanding of sealed bid? Price is quoted. Okay. Okay. So more or less whatever he has said. Now sealed bid, what happens is my company CRISIL Limited makes a tender announcement saying that we are looking for a canteen facility and we want 10 employees to work, or the contractor has to provide food for 500 employees. This is a tender which is announced. Now you may be interested in the contract, somebody else may be interested in the contract. So 50 people put their contract price, whatever terms they want to give, put it in a contract, and there is a bid wherein you drop this, that's all. So now this box will be open in place of these 50 people. Whoever gives the lowest quote, I will try to give the contract to him. That's called as sealed bid pricing. Practically not only the lowest price, there are two ways of analysis which happen. One is technical selection and then the price selection. You have to first fall under the technical selection. You may get rejected. One of the technical selection point could be that the contractor should have been in this industry for 5 years. When you are trying to provide food to my employees, I want you to be there in this industry for a period of 5 years. My second condition could be he should be a person from Tamil Nadu. I can have different condition. Now if you are falling in this condition, if you are failing in this condition, you are eliminated. Then only comes the price wala part. Most of the times practically lowest price is what is selected, provided you fall under the technical bid. You are selected under the technical bid, then comes the final bid. Now the sealed bid pricing is predominantly used in defense industry. It's predominantly used in defense industry. ISRO or DRDO will make an announcement saying that we are looking at XYZ for Indian Army. The announcement comes in, all the multinationals quote for it, whichever is the lowest price, the quote goes to them. These both, in fact, going rate is, at least I know what my competitors are charging. Sealed bid is a perfect strategy for competition based pricing, or a perfect example for competition based pricing, because what I will write in bid is, my first thing which will go in my mind is, what is the other person going to charge? That is what will go in your mind when you are trying to quote in that contract. You will always think about what the other person is going to charge, and based on that you will put your quote. So this is sealed bid pricing. Cost based is, Bharadwaj Institute will do a costing of whatever the expenses they incur for conducting CA classes, add all the cost, add some profit onto it and fix the price. That's called as cost based pricing. In cost based pricing, there can be variable cost based pricing, full cost based pricing, relevant cost based pricing. What cost you take may change based on company to company. You can have different policies. Some company will say, on the variable cost, I'll add a markup to cover fixed cost as well as profit. Some companies will say, no, I'll calculate the total cost and add a profit on it. Somebody will say, we'll calculate the relevant cost and add a profit onto it. So you can have different ways of fixing the price. Now what is value based is, there are two things: true economic value and perceived value. Now what is true economic values? Bharadwaj Institute is providing CA classes, another academy is providing CA classes. Both are exactly the same. The kind of satisfaction which students get is exactly the same. The other company is charging a price of 10,000. Bharadwaj Institute provides you one additional facility to you. That additional facility is that we will keep regular test and correct and give it back to you. That's an additional facility which this academy is providing, the other academy is not providing. Otherwise you feel everything is same. Assume there's the same teacher also, so there is no difference at all between the two academies. Now what is true economic values? Value of the competition product plus value of performance differential. Now Bharadwaj Institute is providing you extra service called as keeping test and correcting them. Now you may attach a value to this as 1000 rupees, 500 rupees, 1500 rupees, or you may even attach a value of 0, because for somebody it may not even make a difference. Somebody may attach a value of 500 to this, 1000 to this, 1000. True economic values, value of competition product plus value of performance differential. The performance differential can be favorable, can be adverse also. It can be a favorable scenario or it can be an adverse scenario. Adverse is the other competitor is providing you extra services, we are not providing you extra service. So you add that 10,000 plus 1,500, 11,500 is the true economic value. The true economic value according to, for true economic value you need to know the price of the competition product. So there is a car by Maruti, there is a car by another OEM. If you feel both are going to serve the same purpose, then if you want to know the true economic value of the Maruti's car, take the price of the competitor plus or minus any performance differential if you feel. What is performance differential? They can come if you see some features are extra in Maruti or some features are missing in Maruti. Clear? Any doubts on this? Perceived value is the value perceived by my customers. Whatever my customers feels it to be. Now we have conducted classes, our fees is 7,500. You may perceive the value of the classes to be 5,000, value of the classes to be 10,000, value of the classes to be 12,000. Whatever is the value perceived by you. You say, you do a discussion and say that the classes conducted by Bharadwaj Institute, we feel that it was good and we can even pay 10,000 rupees. So that is the perceived value by the customer. It can be even on the lower side if you are not happy with the classes. So it can happen either ways. Now I'll discuss in detail as I proceed again on this. Competition pricing is average level charged by the industry. Clear? Now what is competition based pricing is? You change the price based on competitors' action and not based on own cost or demand. You are not bothered about your own cost. My cost is going up, but I am not changing the price because my competitor is not changing the price. How can I change the price? You will practically see all this scenario happening out. You will have so many brands in deodorant, they are not increasing the price because the competitor is not increasing the price. So many brands are there in toothpaste. If competitor is not changing the price, I have a limited flexibility to change my price. Pepsodent and Colgate may increase the price at a same point of time. If Colgate increases, Pepsodent may follow it, or if Pepsodent increases, Colgate may follow it, because they are perfect competitors who are existing in the market. Sealed bid pricing, I have told you. Original equipment manufacturer, defense contract work. True economic value is cost of the next best alternative plus value of performance differential. I'll explain this with a problem in some time. Value of performance differential is you need to find out two products or two services. Both should be similar with certain variation. That variation is called as performance differential. Not an opportunity cost. Not the concept of opportunity cost. You are buying toothpaste, you are buying Colgate. Okay. Now toothpaste and Colgate serve the same purpose. You do not find any difference in toothpaste and Colgate. You see both are serving the same purpose. The true economic value of toothpaste is equal to the price charged by Colgate. That is a true economic value. If the real price of toothpaste is more than Colgate, you will quit toothpaste. You will say, I'll shift to Colgate. Because why you are saying that is, the true economic value for toothpaste is, for your Pepsodent is equal to the price charged by your competitor, because I cannot distinguish between Pepsodent and Colgate. Assume I am not able to. If you are able to distinguish, then you will say there is a performance differential and I'll pay 5 rupees extra, 10 rupees extra, 5 rupees less, 10 rupees less. That's your wish. So when you can distinguish, it's perfectly fine. So the best example which I gave, this is a good example to understand. Bharadwaj Institute classes, another institute classes, both being conducted by the same faculty. When both are being conducted by the same faculty, students are not going to see any difference. So ideally the price should be same. The price can't be different. If the price is different, what will you do? You will go and select the go to the area where the price is less. Now there is only one difference. The Bharadwaj Institute classes will also provide you e-classes. You will have access to the videos later on. Now there is a difference which comes in. And this videos assume are accessible only to the students who are registered in Bharadwaj Institute, and there is a difference of 500 rupees in pricing. Somebody will say, no, I am not going to pay 500 extra, it doesn't make any sense to me. Somebody will say, no, it's easy to pay 500 extra because there is a performance differential, I can even pay 1000 extra. So the true economic value will change based on student to student. So customer to customer it is going to change, because this value of performance differential, the e-classes which is being provided by Bharadwaj Institute, somebody will say has a zero value, because I am not going to look at those videos itself. What is the point of giving me those classes? Somebody will say, no, that has a value of 1000. Somebody will say that has a value of 2000. Somebody will say has a value of 3000. So it keeps changing based on person to person. It's not opportunity cost. It's the cost of the next best alternative, does not mean it's opportunity cost. When I say alternative, it's the alternative product or the service plus or minus performance differential. Perceived value, value that the customer believes. So we are conducting classes. Now the classes itself I have taken through all the examples. Going rate pricing means my fee should be average level of the industry. Competition based pricing is, sealed bid pricing is, if at all there is a concept of sealed bid here, I should try to find out what others are going to charge, and accordingly I charge my prices. True economic values, our other person's service cost plus or minus performance differential. Perceived value is basically whatever you should fix. Now what perceived value says is that my cost of production is 5000. Let's assume there is a product. You believe my cost is 5000, but you believe the value of that product is 8000. My cost is 5000. Perceived value is 8000. What this theory says is you should fix the price somewhere in between. When I fix the price as 7000, my benefit is 7000 minus 5000, 2000 of profit. Your benefit is 8000 minus 7000, because you feel the value is 8000. So you are indirectly thinking you are saving 1000 rupees. That's your indirect thinking, because you felt the value to be 8000. So buyer's benefit is equal to perceived value minus price. Seller's benefit is equal to price minus cost of production. Try to fix the price in between so that both the people are very happy. But the issue is perceived value will be different for customer 1, customer 2, customer 3, customer 4. So those are practical challenges which can come in. Some cost based pricing. Okay, cost based pricing was earlier itself mentioned here. The cost would mean full cost. It can also be on variable cost. It can be a full cost based pricing, it can be a variable cost pricing. Now there is a concept which says that whenever you are introducing, anyway I'll do it in a problem, whenever a new product is introduced in the market, the minimum price of that product should be equal to variable cost. When a product is well established, minimum price should be equal to full cost. What is full cost? Is variable plus fixed. When I am introducing a product, I am okay to report losses, but I am not okay to report negative contribution, because at least I should recover my variable cost. I am not recovering my fixed cost, I am perfectly fine with it when I am introducing a new product. When the product is well established, variable should also be recovered, fixed should also be recovered, and I should start reporting profit. So newly introduced product, minimum price is variable cost. Well established product, minimum price is full cost. Clear? I think this is what is. Okay. Can there be any scenario where you will fix the price below variable cost? Your cost of manufacturing is 100 rupees, but can you fix the price below variable cost at 80 rupees? Do you see some scenarios happening out this way in a real world? when the product becomes outdated, when there is a perishable product. If I have bought fruits, I have to sell fruits in XYZ time. Day 1 no sales, day 2 no sales, day 3 no sales. As my sales reduces, as my sales is not happening, I'll keep changing the price, and I may even fix it below marginal cost, because if you wait, what is going to happen? The value will become 0, because it's a perishable product. So perishable product is a perfect scenario for, in fact, you will see a scenario where the question will say, there is a perishable product, what is the price to be charged? The answer is any price which my customer can pay. Any price which my customer can pay. Okay, I'll give you another example. You have bought a movie ticket. You have to go for the movie 2 days later on. 1 day later, you understand that you will not be in a position to go to the movie. You paid 200 rupees for the ticket. Now you need to sell this ticket. You are trying to find out at what price you want to sell. Logically speaking, any price which somebody can pay is the price at which you should sell. If somebody is even ready to pay 50 rupees, you should go ahead and sell it at 50 rupees. That is what logic says. Because 1 day now, 1 day is still pending, 200 is the price. 6 hours pending, 200 is the price. 2 hours pending, 200 is the price. 0 hours pending, the price is 0. The moment the movie is started, the value of the ticket comes down to 0. So if you are able to find somebody who is ready to pay, so you can try finding out different people and sell your ticket. But in the extreme stage, assume you have such a scenario and you have some 50 tickets with you. 1 day late, early, you find out all the 50 tickets are going to become waste. Your stress will keep increasing as the time passes by. If you are not able to sell it, your stress will keep increasing, and you will feel that, let me sell it now, let me sell it now, let me sell it now. You will reach a stage where you will, if there is only 1 hour left for the movie, whatever is the price, if 100 rupees is coming in, let me sell those 50 tickets and 100 and come out of it, because you know the value will become 0. So there are scenarios where you can fix any price. One of the scenario is where the product is perishable nature. Others are basically, they are saying if you are going to introduce a new product also, you can fix it. Another concept says that it has to be at least variable cost. Practically, according to me, one major scenario is when you have a perishable product, or when you have a large quantity of some product, an outdated product, then you may try to fix, because it is not pricing below marginal cost, it is pricing above relevant cost. The relevant cost of the movie ticket, the moment movie is booked, is 0. The relevant cost of the movie ticket, the moment you have booked your movie, if you have booked the movie, the cost of the movie ticket is 0 beyond that, because you have already paid for it. Beyond that, there is no outflow. Yes also paid, no also paid. Whether you go to movie, you don't go to movie, you cannot go to the theatre and say that I didn't watch the movie, can you return me something? Nothing doing. There's no value attached with it. The moment the ticket is booked, the value of the movie ticket is 0 rupees. So you are pricing above relevant cost and not pricing below marginal cost. Okay. Any idea what are the market entry strategies? You could have learnt in economics. When you introduce a new product, there are 2 types of pricing strategy. Do you remember them? Skimming and penetration. What is skimming pricing? Starting with a high price and then keep reducing the price. Any example of skimming pricing? Okay, luxury product. Apart from luxury, there is one product which you have been using on a daily basis. Mobile phone. When any new brand is introduced, you will start with a price of 20,000. 2 months later, 6 months later, price falls. 12 months later, price further falls. 18 months later, price falls. Then you take the product outside the market itself, you remove the product itself. So mobile phones is something where the price keeps changing or keeps coming down. I have not seen a scenario where the price of the mobile phone has increased. It has only reduced, or at best it has remained constant. Penetration pricing means starting with a low price and then increasing the price. Any example of a penetration pricing? Which one? Jio. Okay, Jio was a penetration pricing, perfect example of a penetration pricing. When they wanted to get an entry into the market, they started with a very low price. People got attracted to it. They gave free offers, all of that, and a lot of subscribers got added. So anywhere you are not able to distinguish your product, you may have to go basically for necessities penetration work, for luxury skimming works. Wherever there is a necessity, penetration works. Anything, beat anything. I want to start with a new restaurant in a crowded place covered with so many restaurants. Maybe I have to start with the penetration pricing, unless I am trying to say that my product or my service is entirely different from the other people in the market. Whenever I have to make an entry into the market, most of the times, unless you are able to distinguish yourself, you will have to come with a penetration pricing. Jio could not distinguish itself with others. Jio was trying to compete with others, so they had to start with a penetration pricing. They even if they wanted to say that we are going to provide 1 GB internet per day, which was not the norm few years earlier, even if they had said and they said that we are going to charge such a high price, they may not have got the entry into the market, because to get the entry into the market, they had to penetrate inside the market, and that could happen only with the low price. Clear? I think this is what it will be entirely. You will have something called as a product life cycle. I will explain that later on. We'll have combination of problem solving and okay, let's first do this. State the pricing policy which is most suitable in each of the following independent situation. Question 7, page 255. I'll take you through 7. 8 onwards you will write it. We'll verify the solution in the printed whatever is given. Now, what are the types of pricing is, listen, competitive pricing, sealed bid pricing, going rate pricing, cost based pricing, true economic value, perceived value, skimming, penetration. Is that the only thing? No, you may introduce something new also. So, you will see it when I do the question. The company makes original equipment and also does defense work. There are other companies which also undertake such projects. I want everyone's participation. Sealed bid pricing. So, write sealed bid pricing. Don't write it in the workbook, write it in your notebook or something, and then we'll check the printed solution. Sealed bid pricing. The product made by the company is new to the market. It is expected to enjoy a long-term demand. Competition is expected very soon, since the product will be desirable to most customers. What pricing strategy? Participate, whatever makes sense to you. Which ones? It's whenever product is new to the market, either it's skimming or penetration. So which one? Skimming. I also felt it to be skimming. I think institute answer is penetration. I'll give the logic behind penetration also. But I think skimming makes more sense here, because there is no competition and the product is going to be desirable to most customers. Now, as we have done at earlier places also, when I did balance scorecard, I said that multiple answers can come in. Here also, at times, multiple solutions can be possible. Even if the question does not ask a reasoning for it, you end up writing the reason. It's okay to write the reason even if the question is not asking for it. Let the reason be there so that the other person understands why you are giving. Only scenario where I don't want reason, where you are very clear that there is no confusion at all. In fact, this looked to be an overall scenario where there is no confusion. I didn't have any confusion unless I looked at the answer, which gave me a different perspective. Now, why skimming? The product is new to the market, no competition, long-term demand. When no competition is there, let me enjoy the market. Now, why penetration could be there is, it is new to the market. When it's new to the market, nobody is ready to buy, because they don't even know what is the product. So, to make people buy the product, I had to penetrate into the market with a low price. The moment people got to know my product, I kept on increasing the price. I'll keep on increasing till my competitors come in. So, that could be the logic for penetration. Anyway, I think institute has given penetration is what I remember. Stock of process ready to eat whose shelf life will soon be over. Product is going to be discontinued. Which one? Which strategy? Which one? Based on relevant cost. Okay, technically it is any price which the customer can pay even if it is lower than marginal cost. Even if it's lower than variable cost. Relevant cost per se is zero only. If the product is already purchased, the relevant cost is mostly zero. So any price which the customer can pay even if it is lower than marginal cost. A company sells a homogeneous product in a highly competitive market. So what is that pricing? Going rate pricing or competitive pricing. You can either call it as going rate or competitive. Let's look at the answers now. Okay, I think the second one, skimming, is what is available. Check it. They have not made penetration. Sealed bid, skimming, any price at which the product can be sold even if it's lower than variable cost, competitive pricing or going rate pricing. Any doubts? Do question 8, write down your answers. New product for the company and the market, large scale production, demand is, what is elastic demand, inelastic demand? Elastic is if you reduce the price, demand will go up. Inelastic is even if you change the price, demand does not change. Elastic demand is normally the scenario in Indian market. India's customers are mostly price conscious, so price plays a major factor in the decision making as far as India market is concerned. So in this scenario, what price you will do? Penetration pricing. Penetration is what will make sense. B is a new product for the company but not for the market. B's success is crucial for the company's survival in the long term. Again, penetration. Already the product is there in the market. There are so many mobile phones there in the market. If I am going to introduce a new mobile phone, I cannot compete with all of these players unless I try to fix a low price. C is a new product to the company in the market, inelastic market, assured profit to cover high initial cost, and usual source of capital have uncertainties. Skimming, perishable item. Any price which the market can offer even if it's lower. Second one, they have given market price or price just below market price. Technically I feel penetration is okay. You can give a logic for your penetration pricing, but the institute answer was market price or price just below market price. That's where I want you to give a reasoning behind your solution, because it may not match, and if it's not matching, they'll directly cancel it and not give marks for it. So at least write the logic so that at least person understands why you are giving the answer. Give only one answer, don't give both the answer. So logic for skimming can be there, penetration can be there. Give one answer and the logic behind that, whatever makes sense to you. State the most appropriate pricing policy to be followed. Modern patented drug entering the market. Which one? I'm not able to hear. It's either skimming or penetration. It'll be skimming. I'll explain what happens in a pharma industry is, lot of companies keep doing R&D. When you do R&D, you will get some new product. The moment you get a product, you will patent it. If patent is done, there is no competitor. This is a reality of the pharma market. The cost will be 1 rupee, it will be sold for 30 rupees. This is a reality of the pharma market. This is not something which doesn't happen. The cost will be only 1 rupee. Why they recover 30 rupees is they have done so much R&D. The R&D could have been on an average some 20 rupees per unit. They have already done the R&D for so many years. Failed R&D, positive R&D, all of this put together, they try to recover. Practically what happens is the drugs go off patent. When the drugs go off patent, lot of people will start manufacturing it. So when it is patented drug, you cannot have any generic drug. Generic is a lot of people selling the same product. So when the product becomes off patented, practically price will fall by 60-70%, because already the product is designed. So all competitors will try to find what product it is. You will understand what is the structure and then prepare that product. That will be done only when it goes off patent, because the cost, I said the cost of manufacturing is very low. So when it is a modern patented drug, the price will be very high. So you start with the skimming strategy. Latest version of a mobile phone launched by an established financially strong company. Not sure, can be skimming, can be penetration, whether you are trying to enter into the market or you are currently there in the market. So established in which industries, I am not sure. So are you established in the mobile phone industry itself? Can be skimming, can be penetration, both I have a logic behind it. Let's see what it is. Looks to be skimming, looks to be more towards skimming, because you are a financially strong company. Apple is introducing its next version of the mobile phone. A practical example to this, mostly it will be skimming strategy. An established company has recently entered the stationery market segment and launched good quality paper for printing at home and office. Which one? Looks more to be penetration, because I am now entering into a stationery market. Tata has now entered into stationery market. Tata's is a very well known name. So, but they are entering into the stationery market. They may not have to reduce the price so significantly as if I am introducing. If Dinesh and company get into a stationery market, nobody recognizes me. Tatas are already recognized, but they are not recognized for paper. So you are now entering into paper. Ideally will be penetration, but they may not need to reduce the price to that extent. I think institute answer is market price. Let's look into the answer in some time. Penetration is what makes sense to me. A car manufacturer is launching an innovative, technologically advanced car in a highly priced segment. Looks to be skimming. A new product is to be sold. High promotional expenditure, demand is not known. When demand is not known and they are talking about high promotional expenditure, it is basically a feature of a skimming strategy. Why you start with a very high prices? Initially you incur high advertisement cost, so high price. Later on you incur less advertisement cost, less price. So that is the reason why skimming starts with a very high price. Looks to be skimming. New product is to be launched, mass manufactured. Mass means large scale production. Wherever there is a large scale, see, skimming is always very less production. There is a uniqueness attached with the skimming product, whereas a penetration is something everybody is going to have. So this is going to be penetration. A product which has an external market demand is to be transferred to another division. Ignore this. This you will learn only when I do transfer pricing, so ignore for the time being. Special one-time order for the use of idle capacity is offered. The order will not impact the existing sales of the company. The product has competition in the market. Think logically and tell me how will you fix the price here. There is no strategy, but you have to tell me how will you fix the price. How will you fix the price here? Any price? No. Even if it's lower than variable cost? I will fix a price which is equal to at least variable cost, because it's an idle capacity. Idle capacity means there is no opportunity cost. the order will not impact the existing sales, because you have been selling at 20 rupees and suddenly you sell at 16 rupees some product, market will get disturbed. So they are saying it will not impact the existing sales. The product has competition in the market, which means, so what I practically will do is variable cost plus some margin, not the full cost, because costing will add fixed overheads also, but all those are irrelevant for us. See, all the techniques which I talk about are everything which I discuss in costing, only one critical thing which is relevant costing. It all works with relevant costing. So here, based on relevant costing principle, what I should do is I should fix variable cost plus some margin. Last one is known to you. What is it? Any price which the market can take. Now look at the answer. First one was skimming. What was the question? Patented, we made it right. Second one, institute has given penetration. Third one, market price is what has been given. I think fourth, fifth, sixth would be right for us. 7, skimming penetration is what we did. 4, 5, 6. 7 we did not do, leave it. Relevant cost plus reasonable markup. That's what I said, variable cost plus your reasonable markup. Any price at which the product can be sold, even if it's lower than variable cost. Any doubts till now? Question 10. State whether the following statements are valid or invalid. When price reductions are introduced to increase sales revenue, the revenue line will be a straight line. Any idea what they are trying to indicate here? This is your whatever you have learnt in economics, but okay. So will it be a straight line? What are they trying to ask us? Why will it not be a straight line? No, so even if it leads to increase in sales, it will not be, even if it leads to the same increase in sales. What they are trying to indicate is units sold 10, 20, 30, 40, 50, 60. What normally will happen is total revenue is 100, 200, 300, 400, 500, 600, 10 rupees, 100 revenue, 20 rupees, 200, 30 rupees, the price is 10 rupees per unit. If it remains constant, then only it will be a straight line like this. Now in this example, what is going to happen is, for 10 units, your revenue is going to be 100. For 20 units, it's going to be 190 because you have reduced the price. 30 units, it's going to be 280. So it's not going to be a straight line, it's going to be a curved line. The reason for curve is your price changes. When it's same price, then only revenue line will be like this. Able to understand this? The revenue line is the total revenue line. Units is written here. Revenues is written in y-axis. So revenues will be a straight line if the price is same. If you reduce or increase the price, if you increase the price, line will move steep like this. If you reduce, it will move like this. When it will be a straight line if it's the same price. Able to understand this? So this is a invalid statement. Second one. What do you mean by this, and do you think it valid or invalid? Okay, I'll explain what it is. Coca-Cola has a capacity of 1 crore bottles to be manufactured in a year, 1 crore bottles. They are saying when you try to fix the price, please fix the price in such a way that you can sell 1 crore bottles. That is what the line says. Volume consideration should be taken into account so that fuller capacity utilization can be done. Don't try to fix the price in such a way that you sell 60 lakh units or 80 lakh units when you have a capacity of 1 crore. Do we take into consideration this when we try to fix the price? Practically, yes. Provided it also gives you maximum profit. It's not that I will focus, I'll compromise on profit for that. But my objective will always be to do full utilization of capacity. Based on full utilization of capacity only, I'll try to fix my price. There is no price policy in perfect competition. An example is petrol bunks. So you think about, do they have any pricing policy? There's no policy. They know what price is to be fixed on a daily basis. They get instructions saying that IOCL, BPCL, HPCL have changed the price. You boss, please follow it. That's all. I don't have any pricing policy in a perfect competition, because people can't even differentiate between two products. So where is the policy? I cannot think that my customer would want this or would not want this. So there's no concept of a price policy in perfect competition. Looks to be a valid statement. Rate of return to be earned should cover the risk involved in business. This is a concept of finance, not costing. Tell me, do you think it to be logical or not logical? More risk, more return, less risk, less return. Looks to be a valid statement. Survival and progress of a firm depend on its ability to maintain and replace its fixed assets. Think about it and tell me what do you feel about this statement. Should I keep changing my fixed assets? Should I keep modernizing my fixed assets with every few years, or I can leave my fixed assets as it is? If you leave fixed assets as it is, what will happen? They'll become obsolete, your efficiency will drop, competitors will be able to produce at a lower price, you will not be in a position. So practically it's very, very critical to keep changing your fixed assets whenever a need arises. Let's look at the answers. First one is invalid, everything else is valid. Now let's get into problem solving mode now. Let's start with question number 1. Whatever I'm going to do in problem solving, whatever you learnt in marginal costing and relevant costing will only come here. Rational Limited produces 3 lakh kgs of S and 6 lakh kgs of Y from an input of 9 lakh kgs of raw material Z. The selling price of S is 8 per kg, Y is 6 per kg. Processing cost amount to 54 lakhs per month as under. There is an offer to purchase 60,000 kgs of Y additionally at a price of 4. Y will not be affected, but the price of S is likely to be decreased uniformly on all sales. Find the minimum reduced average price for S to sustain the increased sales. Go through this. What is S and Y technically called as? They are joint product. Now the peculiarity of the joint product is, if demand for one product increases, the demand for the other product also has to increase. Otherwise I cannot produce the product, because both the products will be manufactured together. I've got a special order for which product? Y. But the issue is they want us to calculate price for S. They have given the order for Y, but they're asking price for S. Why? Because when you take up the order of Y, production of S will increase. When production of S increases, you have to sell more units, and to sell more units, you have to reduce the price. My minimum price should be one that does not lead to fall in profits. Today, we will calculate the profit for 9 lakh units, or for the 3 lakh and 6 lakh combination. Tomorrow, it is going to become 6,60,000 of Y, 3,30,000 of S. This 330 plus 660 ka combination cannot lead to fall in profits. At best, give me the same profit. If profits are going to come down, I'm not going to take up the order. That is what the concept is. Let's working note 1, calculation of existing profit. Calculation of existing profit. Particulars calculation amount. Calculation of existing profit. Revenues of product S. You can keep filling this. Revenues of product Y. Everything is there in the question. See it and fill this. Revenues of product S and revenues of product Y. Product S and product Y. Less processing costs. Variable raw material, variable, fixed and profit. Why are we taking? It's a normal P&L, you will take fixed into consideration. Both the places, existing scenario also you will take, revised scenario, or both the places ignore it, doesn't make difference. You consider both the places or ignore at both the places. In a normal P&L, you have to consider fixed into consideration. Minus 27 lakhs. This is the profit I am generating today. ₹6 lakh of profit. Now listen, I'm going to do the same statement again. Listen for a minute and then you can fill this. It will become 3,30,000 into something. That something is what you are trying to find out. Units will go up to 330 because you have got an extra order for 60,000 units of Y. With 60,000 units of Y, you will get 30,000 units of S. This is 6 lakh into 6 plus 60,000 into at what price you are getting the new order? 4. You see whether any of these has to be changed, raw material, variable and fixed. The only thing which I know is my profit has to be 6 lakhs. You ensure that this number is 6 lakh. You can write whatever you wish to write. Balancing figure is this question mark. You see whether variable, raw material, fixed, any of this needs to be changed, change it. But my final requirement is profit has to be 6 lakhs. It cannot fall. Any doubts in this? Basically what is happening is today you are processing 9 lakh kgs. This 9 lakh kgs of processing will now go up to what kgs? 9 lakh? 90, it not 9,60,000, it will go up to 990. 60,000 units of Y will be added with 30,000 units of S. When you are getting Y, you also need to sell or manufacture product S. Do this and let me know that question mark. We need a minimum price of 7 rupee 91 paise. $26,10,000 is the balancing figure for revenues of S. That 2610 divided by 330. 2610 is the balancing figure that you divide by 3,30,000. Done? Can you proceed? Any doubts in this? Clear? 26 lakh 10,000 is a balancing figure. The minimum price is 7.91. We'll move to question 2. Hind Metal manufactures an alloy product in cop by using iron and copper. The metals pass through two metals X and Y. The company gives you the following details for the manufacture of 1 unit of INCOP: materials, wages, overhead recovery, fixed overhead, variable overhead, selling overhead. Find out the minimum price to be fixed for the alloy when the alloy is new to the market. Briefly explain its pricing strategy. After the alloy is well established, what should be the minimum selling price and why? What should be the minimum price if the alloy is new to the market? Minimum variable cost. When it is well established, full cost, variable plus fixed. Let's first calculate these two and then write. Working note 1, calculation of variable cost and full cost. Calculation of variable cost and full cost per unit. First we'll capture all the variable costs. Materials, there's no major calculation as such. Iron and copper. Materials, iron and copper. $50 and $40. Wages, plant X and plant Y. Plant X is how much? 45. Please participate. There's nothing there to calculate also. 45. Plant Y is 60. 5 into 12. Iron was 10 into 5, copper was 5 into 8, wages is 3 into 15, 5 into 12, variable overhead. Let's first capture all the variable cost. Plant X and plant Y. Read it carefully and do this calculation. Plant X and plant Y, variable overhead. 8 into 3 for 8 per hour in plant X. So 8 into 3 hours, and plant Y is 5 into 5 hours. 8 into 3 and 5 into 5. So 24 and 25. 8 into 3 and 5 into 5. Then we have selling overhead, which is also variable, 20. Total variable cost or VC per unit, VC per unit 264. Then fixed overhead, plant X and plant Y. Plant X का fixed overhead is 8 into same 8 into 3 and 5 into 5. 8 per hour and 5 per hour. Full cost Any doubts on that 24 and 25? $313, $264 and $313. $264 and $313. Any doubts on this? Now write the minimum price when the alloy is new to the market, the minimum price when the alloy is new to the market, when the alloy is new to the market will be the variable cost, will be the variable cost of rupees 264, will be the variable cost of rupees 264. Full stop. The company is following the penetration pricing strategy. The company is following the penetration pricing strategy. Penetration pricing strategy to get an entry into the market. Penetration pricing strategy to get an entry into the market. Next, if the product is well established, then the minimum selling price, would be equal to full cost of rupees, how much? 313. Full stop. This is because the company would like to report profits. Company would like to report profits once the product is well established. Company would like to report profits once the product is well established. So till it is not established, I am okay to report losses, but if it's well established, I need to make money. Go through question 3. Please read through that. Now coming to this question, Computer Tech, a manufacturing company, has entered into an agreement of strategic alliance with Compinc of USA. So Computer Tech is the I think Indian company and Compinc is the US company. Compinc will provide Computer Tech with kits in dismantled condition. These kits will be used in the manufacture of supercomputer in India on a value basis. The price which has been fixed for the dismantled kit is 50% of the FOB price. Computer Tech will procure the balance of materials in India. Compinc will provide to Computer Tech with designs and drawings. For this you have to pay some technology fee, some royalties to be paid. The other details are given. Calculate the selling price of a personal computer in India, bearing in mind that Computer Tech has targeted profit of 20% to itself on the selling price. So I need a profit of 20% on the selling price. Now if I look at the cost, my first cost is a dismantled kit, whichever is coming from my foreign partner. In the dismantled kit, I have FOB price, I have insurance and freight, I have customs duty. These three I'll have to add and get what is the cost of the dismantled kit. The second cost which I have to pay is technology fee. For the technology fee, this is the information given. It expires with production of some 8 lakh computers. So I'll have to do some calculation and find what is the cost per computer. The third thing is Compinc will procure the balance of materials in India. I have to procure some materials in India, which is given here. Estimated cost of materials and supplies to be obtained in India will be 150% of the cost of supplies. Fourth is assembly and other overheads. And the fifth cost is royalty. There is some equation given, so I'll have to try to find that what is royalty they are saying. All this 5 costs put together add a profit and we fix the selling price. Working note 1, calculation of selling price of supercomputer in India. Calculation of selling price of supercomputer. Particulars, calculation, amount. Point number 1, cost of dismantled kit. Note 1, cost of dismantled kit. Note 1, leave some 10 lines, come down. Cost of dismantled kit. This kit is going to come from the US, so I have to see what is the cost for that. Again, particulars, calculation, amount. Particulars, calculation, amount. First is the FOB price. I have to pay the FOB price to my supplier from US. What is the FOB price I have to pay? $2,040. 55 rupees is the exchange rate, so I'll have to convert into INR. But read it carefully. Am I going to pay the entire FOB price? On a value basis, the supply in terms of the FOB price will be 50% thereof. So though the price is 2040, I'll pay only $1,020. That has been agreed with my supplier. So point number 1, basic price $2,040 into 50% into 55. $2,040 into 50% into 55. How much is this? How much? 56,100 I have to pay. Second, insurance and freight. Insurance and freight. This is, if you add the basic price and insurance and freight, it is called a CIF, cost, insurance and freight value. So we'll add this because my customs duty is charged on CIF in this question. So add this and call it a CIF value. CIF value 58,100. Customs duty. What's the customs duty? 40% of CIF. How much? 34. Why will it be 34? 58 plus 23. Cost of dismantled kit. How much? 81,340. This is my first cost. The dismantled kit itself will come to me only at 81,340. Clear? Can we proceed? So put this 81,340 here. Cost of dismantled kit 81,340. My second expenses, technology fee. Per computer, what is the technology fee? Read it and let me know. For a single computer, what will be the technology fee? $8 crore by 8 lakh computers. So 800 lakhs by 8. 100 rupees the technology fee. 800 lakhs by 8. Any doubts on this? Third one is local procurement. I have to buy something in India also. Got the kit, paid the technology fee, need some components in India. What they are saying is the estimated cost of materials and supplies to be obtained in India will be 150% of the cost of supplies made by Compinc. Now how should we interpret this? You tell me how do you want to interpret it, and then I'll tell you the institute's interpretation. Multiple interpretation are possible here. Now tell me, how do you want to mention this? 150% of the cost of supplies made by Comp Inc. Till this, tell me how are you going to calculate this? What do you understand by this? That 50% wala part, leave it. Which one? So tell me what calculation you want to do here. 150% into what? 81. Okay, that's one interpretation. I'll tell you whether that interpretation will work or not. 150% into 81,340. Second interpretation is okay. Now I'll come to the institute interpretation. I felt it to be this to be the right interpretation. That is cost of supplies made by comping. For me, the cost is 56,100 because I have already got this product. I thought from my perspective, but they are saying cost of supplies made by comping means cost of manufacturing by comping, and that is where they gave this information. The quoted price of the kit included a 25% margin of profits on cost to comping. So the profit for the comping is known. Based on that, cost of comping can be calculated. Based on that cost of comping, you will calculate into 150%. Logically speaking, this may not be the right interpretation because I may not know what is the profit my supplier is making, though it's my holding company, but still I will not get to know what is the profitability they are making. Institute's interpretation is that they have given the profit margin, so first calculate what is the cost of comping. See, the kit, when you look from comping point of view, they will say 5600 minus something. When I look from my point of view, I can even say it as 56,100 or 81,340 because I also paid a customs duty. So it depends on how do we interpret. Now coming to the institute's interpretation, I'll give a note on this in some time. 56,100. What the profit margin it includes? 25% on cost. 1 by 4 on cost is 1 by 5 on sales. For the other company, 56,100 is the selling price. For them, it's the selling price minus 1 by 5 of 56,100 into 150%. 56,100 minus 1 by 5 of 56,100 into 150%. Institute's interpretation is this refers to the cost by the main parent company itself. $100 minus 1 by 5 of 56,100 into 150%. How much? That standard wala part will come later on. As of now, it doesn't matter. $67,320. $56,100 minus 1 by 5 of 56,100 into 150%. Fourth expenses, assembly and other overheads. It's directly given. How much is assembly and other overheads? 8,000. Final item is royalty. Any doubts till now? Now I'll come to the royalty part. They have given some definition of royalty. What they have mentioned is 10% of the selling price as reduced by the cost of standard items procured in India. They have given standard items is equal to what? Something is mentioned in the question. 50% of the value in rupees of the locally procured goods represent cost of the standard items, and also the cost of imported kits from comping. Now please listen. Coming to my royalty, as of now I am writing it as X. I will give an equation on this in some time. My selling price is going to be Y. Let me form these two things. Later on I will take you through how do I solve the royalty wala part and the selling price. So as of now royalty is X. Put a total cost plus profit and selling price. Selling price is Y for the time being. Royalties as of X, selling prices as of Y. As of now X and Y. How much is the total cost? And what's the profit margin they want? 20% on 1 by 5 on sales, 1 by 4 on cost. So my profit margin is we'll try to form two equations and then we'll get the answer to x and y. X is the royalty, Y is the selling price. Royalty depends on the selling price depends on the royalty. So you cannot solve it directly, you need a simultaneous equation. Now listen, my first equation is selling price is equal to cost plus profit, Y is equal to 156,760 plus X, profit is simplify this equation and tell me y is equal to what? $1.25x plus something. How much? 1,95,000. 9. Okay. 195,950. This is my first equation. Can I proceed to the royalty ka equation? Any doubts in this? Now coming to royalty, read that line and I'll write it as of now. Royalty is equal to 10% of what they mentioned. Selling price minus standard procurement minus cost of imported kit. Now my royalty, my definition was X. 0.1, listen for some time, selling price is Y, standard procurement is 50% of what was the figure, overall procurement in India. Local procurement was 320 and cost of imported kit, in this case they have taken the overall cost, which is to do the profitability statement, they have taken the overall cost. It was 81, how much? You will get a equation for X now, you have an equation for Y, use the rule of substitution and get me the X and Y. 10% of selling price minus standard procurement minus imported kit. Is this the price you get? 2,07,514. You easy thing is to do a substitution. You substitute the value of x in the first equation. In place of x you write 0.1y minus 11,500. You substitute that, the equation gets simplified and you get this number. So we'll have to fix a price of 2,07,514 if we have to make a 20% profit. You can also get the royalty ka figure. What will be the royalty number? 9251. So the royalty will be 9251 and overall price is 207,514. Any doubts on this? Cost of manufacturing will become 1,66,011 when you add the royalty, and with the profit margin you will fix a price of 207,514. Any doubts in this? Can you proceed? Clear? Let's move to question 4. Can you proceed? Any doubts on 207,514? Question 4. Determine the selling price per unit to earn a return of 12% net on capital employed, net of tax at 40%. COP and sales details are available. Fixed portion of capital employed and the varying portion is available. Okay, the question talks about the need a return of 12% on capital employed, which is after tax. When I do my analysis, tax is never considered, so I want the pre-tax return. If you want 12% after tax, what is the pre-tax ROCE you want? If the tax rate is 40%, pre-tax number 20%, 12 divided by 1 minus tax rate. So you will need a 20% pre-tax ROCE to get the required return. Now write point number 1. The company needs a post-tax. The company needs a post-tax ROCE. Needs a post-tax ROCE of 12%. ROCE of 12%. Full stop. The tax rate is 40%. And the pre-tax ROCE will work out to be 12 divided by 1 minus tax rate. 12 divided by 1 minus 40%. So we need a 20% return on capital employed. Now listen, I have my cost here. Cost plus profit is equal to sales. What is profit? Profit is 20% of capital employed, because you need a 20% return. So profit is equal to 20% of capital employed. What is capital employed is? Now to calculate profit I need sales, and to calculate sales we need the profit. So somewhere some equation will have to come into picture, or you will have to assume something as x and do it. Now right, let us assume the overall sales to be X. Let us assume the overall sales to be X. Let us assume the overall sales to be X. Now listen, capital employed is equal to, right, capital employed is equal to fixed capital plus variable capital capital employed is equal to fixed capital plus variable capital. What's the fixed capital? 12 lakhs. Variable capital 0.5x, 50% of sales. We have assumed that the overall sales is X. So my variable capital is 0.5x. Clear? You can assume the selling price also as X or the overall sales to be X. If you assume selling price as X, overall sales is 80,000 X. Next, profit is equal to 20% of capital employed, which is 12 lakhs. %20 of 12 lakh plus 0.5x. $2,40,000 plus 0.1x. My profit margin has to be 20% of capital employed. Any doubts till now? Cost plus profit is equal to sales. You know the cost, you know the profit in terms of X, sales is X. Somewhere you will get the answer to X. So then cost plus profit is equal to sales. Tell me the overall cost figure. Cost plus profit equal to sales. How much is the cost? 14 lakh. Profit is and sales is, get the value of sales, divide by the number of units to get the selling price. $23. I'll fix a price of 23.61 to get whatever is the requirement. The selling price will be 23.61. Whatever profits we wanted to achieve, we can get it by fixing a price of 23.61. Clear? Can we proceed? Any doubts on this? Let's go to question 5. LMV Limited manufactures product Z in department A and B, which also manufacture other product using same plant and machinery. Information of product Z is as follows: direct materials per unit, direct labors per unit, fixed overhead, variable overhead, value of plant and machinery. Overheads are recovered on the basis of DLH. Variable selling and distribution overheads is 30,000 per month. The product requires a working capital of 4 lakh at a target volume of 1500 units per month, occupying 30% of practical capacity. To calculate the price of product Z to yield a contribution, minimum selling price if the product is well established, product is first time launched. Go through this and do part 2 first. Well established and first time launched. Complete that. That information is needed for me to do part 1. Go through and try to do the part 2. Well established and first time launched. You'll have to calculate the variable cost and fixed cost, like we did it in one of the question, that in COP question. Get me the variable cost and fixed cost. Minimum selling price well established is, variable cost and full cost. Let me know in case there are doubts here. minimum selling price when the product is newly introduced will be 175, well established is going to be 215. $175 and $215. If this is done, I'll take you through the part 1 of the question. 175 and 215. Minimum price for newly introduced product is 175. Well established is 215. Can we proceed? Any doubts on 175 and 215? Okay. Now listen. Calculate the price to yield a contribution. The word is very clear. Yield a contribution to cover 21% return on investment. Last problem, profit was 20% of capital employed. This question, contribution is 21% of capital employed. It's contribution, not profit. If it was profit, I would have added to the total cost. If it's contribution, I'll add only to the variable cost. Now, manufactures product Z in department A and B, which also manufacture other product. Now, department A and B put together has a capacity of 40 lakh rupees of machinery. But entire 40 lakhs is not used for me. For me, only some percentage is used. What is that percentage? 30% of the practical capacity. So, investment for product Z is equal to 30% of department A's plant and machinery, 30% of department B's plant and machinery, plus working capital of 4 lakh. Working capital is also an investment. Investment is nothing but equity plus debt or fixed assets plus net working capital. So, now write part 1 of the question. Calculation of price to yield a contribution. Calculation of price to yield a contribution of to cover 21% ROI. To cover 21% ROI. Point number A, product Z is made in department A and B. Z is made in department A and B, which also department A and B, which also manufacture other products. Which also manufacture other products. Full stop. Investment in A and B. Investment in A and B. A and B is rupees 40 lakhs. Is rupees 40 lakhs, and 30% of that is used for product Z. 30% of that is used for product Z. Next, investment for product Z equal to for product Z equal to 30% of plant and machinery plus working capital. 30% of plant and machinery plus working capital. The investment is how much? $16. 30% of 40 lakhs plus 4 lakhs. Investment is 16 lakhs. Any doubts on this? 30% of 40 lakhs plus 4 lakh of working capital. Can we proceed? Contribution is equal to 21% of 16 lakhs. This is 3 lakh 36,000. 3,36,000. Any doubts on this? Now this is my full year contribution. Normally ROI is for a year. So 3,36,000 is what you need for the entire year. In a month, how many units we are selling? 1,000. So contribution per unit is equal to 336 by 1,500 into 12. Whatever is the contribution per unit number has to be added to the variable cost. What's the per unit contribution? 18 point. I need a contribution of 18 rupees 67 paise per unit to get a 21% ROI. 18 rupees 67 paise. Now listen, my working capital said 4 lakhs per month. The working capital 4 lakh per month means it is going to remain the same 4 lakh only. That is not 4 lakh into 12. You cannot make that as 48 lakh because investment is only made once in working capital. And that 4 lakh is a floating amount. It will keep rotating and you will continue to have 4 lakh. So my investment was 16 lakhs. I wanted a contribution of 3,36,000. Contribution per unit is 18.67 and selling price is 193.67. If they had said that to yield a profit, then we would have added to 215. Let's move to question 6 then. 193.67 is the price which will be fixed by the company. They will fix a price of 193.67. Go through question 6. Now I have to fix the price to get a 20% return on investment, 6% profit on list sales when the trade discount is 40%, something on list sales and trade discount is given. Investment is already available in the question. Investment is 1,50,000. The only thing you have to assume is it a 20% before tax or after tax? If it is before tax, then you straight away apply it. If this 20% is an after tax number, then you have to convert this into a pre-tax number. Now working note 1, fixation of selling price to get 20% ROI. Fixation of selling price to get 20% ROI. To get a 20% ROI. Alright, it is assumed that the company needs a 20% post tax ROI 20% post-tax ROI. Next, pre-tax ROI equal to post-tax ROI divided by 1 minus tax rate. Any doubts on this? Then you can write profit equal to, how will you get the profit? 33.33% of what? Of 1,50,000 investment. Profit equal to 33.33% of investment. Profit equal to 33.33% of 1,50,000. 50,000. Sales is equal to cost plus profit. Get the sales value and the selling price. Cost plus profit. My cost is 1,50,000, sales is 150, ₹10 per unit is the selling price. 2 lakh by 20,000, 10 per unit is the selling price. Any doubts on this? Clear? Now 6% profit on list sales when trade discount is for. So there is something called as a list price. On top of the list price, there will be discount which will be given by the company. List price basically indicates the quoted MRP. That is not my revenue. My revenue is list price minus trade discount. Now the question's requirement is I want a profit of 6% on list sales. First I have to assume that 6% is pre-tax or post-tax. If it's post-tax, I'll have to convert. So to ensure consistency, we'll do the conversion. Now, working note 2, calculation of price to get 6% profit on list sales. All right, it is assumed that 6% is the post-tax profit. 6% is the post-tax profit, and the corresponding pre-tax profit is 10% of list sales. Corresponding pre-tax profit is 10% of list sales. Okay, now listen for 2 minutes. Particulars and amount. My starting point is list sales. This is not my revenue. In this I have to deduct the trade discount. How many units are getting sold? 20,000. So I'll call it as 20,000 X. X is the list price, okay? X is the price less trade discount. How much is the trade discount percentage? Net revenue. This is only my revenue. Revenues is 12,000x, cost is 1,50,000, profit is 10% of list sales. I am writing that only for the purpose of writing 10% of 20,000x. Otherwise, I don't need it. 12,000x minus 1,50,000 is equal to 2,000x. You can get the price. 12,000x minus 1,50,000 is equal to. This is not my revenues. My revenues is only the net amount. The gross amount is just returned to get the profit amount. So do this and get me the answer to x. What is the answer to x? So list price is 15 and what I will get is only 9 rupees. So my list price is 15, but what I am going to get from my customer is only 9 rupees because there's a discount which is to be given of 40%. Any doubts on this? List price is going to be 15 rupees. Go through question 12. Okay, now they've asked us to calculate true economic value. The question is not fully complete. The basic thing is we require the true economic value of this package which is being provided by Deccan Tour Limited. What is the price they are charging? 15,000. But the true economic value will depend on what is the competitor charging. What is the competitor charging? 14,500. My competitor is charging 14,500. Is he giving more facility or I am giving more facility? he is giving more facility. So should I pay more than 14,500 or less than 14,500? Less than 14,500, because he is also giving a pick up and drop facility. Now write true economic value equal to cost of next best alternative, plus or minus value of performance differential. Cost of next best alternative plus or minus value of performance differential. Cost of next best alternative plus or my next best alternative is asking me to pay only 14,500. On top of that, my facilities are not adequate, so I will subtract another 1,600. I'll subtract 1,600 and I would like to pay only. This is the true value of this package which is providing, but he is charging how much? Ideally, I should reject this package, because according to me, the true value of this package is only 12,900. If he is charging anything more than 12,900, I should shift to the other guy, because he is charging only 14,500 and giving a pick up and drop facility. Clear? Go through question 13. Go through 13 and try doing it. Okay, how will you proceed doing this? Monopoly 1,200 units gives you a profit of 1,06,000. Fixed cost is 74,000, which will tell me what is the contribution. Contribution is going to be 1,80,000. With that, I'll get the contribution per unit, and this line will tell you what is going to be the selling price. Working note 1, calculation of selling price under monopoly. Calculation of selling price under monopoly. Selling price under monopoly. Point number 1, 1,200 units. 1,200 units give profit of 1,200 units give profit of rupees 1,06,000. Give profit of rupees 1,06,000. Full stop. The fixed cost is 74,000. Is 74,000, and hence the overall contribution is 1,80,000. Overall contribution is 1,80,000. Next point, contribution per unit equal to 1,80,000 divided by 1,200. 1,80,000 divided by 1,200. 150. It's 150, no? Yeah. 150 per unit. Any doubts on 150 per unit? Now listen, contribution is as high as 3/4 its variable cost. Can you tell me what will be the variable cost? Contribution is as high as 3/4 its variable cost. What will be the variable cost? So what is that number? 200 will be the variable cost, because they said the variable cost is as high as 3/4 its sorry, contribution is as high as 3/4 its variable cost. Next, right? Contribution is 3/4 of variable cost. Contribution is 3/4 of variable cost, and hence variable cost is 4/3 of contribution. Variable cost is 4/3 of contribution. Monopoly, the selling price is 350. Now you need to tell me how will you do in perfect competition. I'm not going to help you out in this. You should be in a position to tell me in perfect competition. Okay. ठीक है. Contribution per unit is possible. Beyond that, what do you want me to do? Variable cost will remain same. It's not going to be that variable cost will now become 4/3 of contribution. That is only for the monopoly market. Variable cost, so it is like this: 1,80,000 divided by 6,000, 30, 200 and 230. My price is 230 rupees. 30 rupees is the contribution per unit. 1,80,000 divided by 6,000 units. 1,80,000 divided by 1,200 units. 1,80,000 divided by 6,000. So you get a 30. Add a variable cost of 200. My cost cannot change. It can't be 3/4 and 4/3. Those relationship will not work out. And selling price is 230. Next, price under perfect competition market. Price under perfect competition market. All right. The company will be selling 6,000 units. Will be selling 6,000 units to earn a contribution of 1,80,000. 6,000 units to earn a contribution of 1,80,000. Contribution per unit equal to rupees 180 by 6,000. Which is 30 per unit. Any doubts on that? Next point. VC per unit would remain same. VC per unit would remain same at 200. VC per unit would remain same at 200. Would remain same at 200. Full stop. Selling price equal to 200 plus 30. Any doubts on this? Go through question 14. Okay. Now coming to this question, they have given the details of the company and the company wants to produce 2 lakh units, which means they also want to sell 2 lakh units. That's a normal understanding, whatever you want to produce. What is the proposed pricing policy? Markup of 25% on full cost. Let's first try to fix what price the company wants to do. After fixing the price, let's see whether it is in line with this. You want to sell 2 lakh units. If you have to sell 2 lakh units, the price has to be somewhere lower than 44. Because at 44 itself, we are able to sell only 1,68,000. So the price has to be far lower than that. Let's see what the question gives. Working note 1, calculation of budgeted price. Calculation of budgeted price. Particulars calculation amount. Calculation of budgeted price, particulars calculation amount, variable cost, I can do at a per unit level or also I can do at an overall level. I am doing at an overall level. 32 into 2 lakhs. Variable cost 32 into 2 lakhs. Fixed cost, it's profit on full cost basis, so fixed cost has to be taken. Total cost, add profit and then sales. Total cost, add profit and then sales. Profit is 25%. We wanted to sell entire 2 lakh units, so I've tried to find out at what price can we sell those 2 lakh units. Now The objective of the company was to make a profit of 20% on cost, and according to that they should fix a price of 50 rupees. Sorry, 25% on cost. According to that they should fix a price of 50. At 50, how many units you can sell? So whatever they have planned is not going to work out. So whatever is their plan, it's not going to work out. Let me analyze which is better in this 5 then. But whatever is their plan is not going to work out for the company, because at a price of 50 they can sell how many units? 1,40,000. Now write no comments. The company will not be able to fix a price of 50. Will not be able to fix a price of 50 rupees for its full capacity. For its full capacity. Full stop. It can sell only 1,40,000 units. It can sell only 1,40,000 units. 1,40,000 units at a price of rupees 50 per unit. So we have told them, boss, this is not possible. Now let's analyze those 5 alternatives. Whichever is giving me maximum profit or a different ratio in this, I'll tell the ratio in some time. That is what the company is going to select. Next, evaluation of 5 alternatives. Evaluation of 5 alternatives. Particulars, alternative 1, they have given 5 alternatives in the question. I'll give you the format, listen for some time and then you quickly fill it. Listen, units, total variable cost, total fixed cost, total cost, sales. Okay, I'll capture the selling price and sales here. Finally, profit. Institute has taken a ratio called as profit as percentage of total cost to make the decision. Why they have taken this ratios? The objective of the company was to make a 25% profit on total cost. So we'll try to see whether that is possible. Profit as a percentage of total cost. Otherwise, to calculate only the profit, the easier way is to do contribution approach. Selling price less variable cost, contribution per unit, total contribution less fixed cost and profit. That's the easier way. But Institute has taken a ratio called as profit as a percentage of total cost to make the decision. So unit selling price you multiply, you will get the sales. Units into variable cost will give you TVC, TFC, TC, profit, and then profit as a percentage of total cost. Fill this now. Complete this, we'll write the conclusion. What is the price we should fix now? 56 or 60, that's the doubt I have. Should I fix a price of 56 or 60? Should it be 56 or 60? What should be the price? Can you just focus on the table and let me know? Please focus on the table. Calculation you can even complete at home. Should it be 56 or 60? Please participate, friends. You have the table in front of you. You need to fix the price. Is it 56 or 60? 56 is maximum profit. 60 is maximum profit as a percentage of total cost. Which one is better? It has to be 56 because what matters to us is maximum profit, not the percentage. Now wait. Even if this ratio was below 25, this is 25, more than 25, the target was 25. Even if it was 24, 23, unless the question is very, very categorical saying that I need that 25%, otherwise I'm not agreeing. If that compulsion is not there, even with a 23-24% margin, I'll select only 56 because what matters to us is the maximum profit. Here we are saying, boss, you will make the maximum profit and also meet your level which you have decided. Now write conclusion. The company should fix a price of 56 per unit. Should fix a price of 56 per unit. $56 per unit to yield maximum profit of 14,72,000. Maximum profit of 14,72,000, full stop. This will also help the company in meeting its profit target of 25% on cost. Clear? With that, I'll end today's session. We'll continue in the next class.